Welcome to our deep dive into peer-to-peer lending, often called P2P lending. In this video, we'll explore what P2P lending is, how it works, and why it has become such a popular alternative to traditional banking. Whether you're a potential borrower looking for flexible loan options or an investor seeking new opportunities, understanding P2P lending can open up a world of possibilities. Let's start by defining the basics and setting the stage for a journey through the world of modern finance. Peer-to-peer lending is a financial system that connects borrowers directly with individual lenders through online platforms. Unlike traditional banks, P2P platforms act as intermediaries, matching people who need loans with those willing to lend money. This model removes the need for banks, often resulting in lower interest rates for borrowers and higher returns for lenders. The process is streamlined, digital, and accessible to a wide range of users. P2P lending emerged in the early 2000s, with the first platforms launching in the UK and the US. The idea was simple: use the internet to connect people who have money with those who need it. Over the years, the industry has grown rapidly, attracting millions of users worldwide. Today, P2P lending is a multi-billion-dollar industry, offering loans for everything from personal expenses to small business growth. The process of P2P lending is straightforward. Borrowers apply for loans on a P2P platform, providing details about their financial situation and the purpose of the loan. Lenders review these applications and choose which ones to fund. The platform handles the paperwork, payments, and collections, making the experience seamless for both parties. This digital approach makes lending and borrowing more efficient and transparent. There are three main players in the P2P lending ecosystem: borrowers, lenders, and the platform itself. Borrowers are individuals or businesses seeking funds. Lenders are people or institutions looking to invest their money for a return. The platform acts as a facilitator, ensuring that transactions are secure and that both parties meet their obligations. Each player has a unique role in making the system work smoothly. For borrowers, P2P lending offers a flexible and often faster alternative to traditional bank loans. The application process is usually online with less paperwork and quicker approval times. Borrowers can often access funds at lower interest rates, especially if they have good credit. This makes P2P lending attractive for personal loans, debt consolidation, or funding a new project. Lenders in the P2P market are often individuals looking to diversify their investments. By lending directly to borrowers, they can earn higher returns compared to traditional savings accounts or bonds. However, lending also comes with risks such as borrower default. Platforms often provide tools to help lenders assess risk and diversify their investments across multiple loans. P2P platforms are the backbone of the system. They handle everything from verifying borrower information to processing payments and managing collections. Security and transparency are top priorities, with platforms using advanced technology to protect user data and ensure fair transactions. Many platforms also offer customer support and educational resources to help users navigate the process. P2P lending platforms offer a variety of loan types. Personal loans are the most common, but you can also find business loans, student loans, and even real estate financing. Each loan type has its own requirements and risk profiles, allowing both borrowers and lenders to choose options that best fit their needs and goals. Interest rates in P2P lending are typically set by the platform, based on the borrower's creditworthiness and the loan's risk level. Rates can be lower than those offered by banks, especially for borrowers with good credit. For lenders, high-risk loans may offer higher returns but also come with increased chances of default. Understanding how rates are determined is key to making informed decisions. For approving a loan, P2P platforms assess the creditworthiness of borrowers. This involves checking credit scores, income, employment status, and other financial details. The goal is to minimize risk for lenders while ensuring borrowers can repay their loans. Some platforms use advanced algorithms and data analytics to make these assessments more accurate and efficient. Applying for a P2P loan is usually simple and fast. Borrowers fill out an online application providing details about their financial situation and the purpose of the loan. The platform reviews the application, assesses risk, and assigns an interest rate. If approved, the loan is listed for potential lenders to fund. This process can often be completed in just a few days. Once a loan is approved and listed, lenders can choose to fund all or part of the loan. Many platforms allow multiple lenders to contribute to a single loan, spreading the risk and making it easier for borrowers to get funded. When the loan is fully funded, the money is transferred to the borrower and the repayment schedule begins. Borrowers repay their loans in regular installments, which include both principal and interest. The platform collects these payments and distributes them to the lenders. For lenders, this means a steady stream of income as long as the borrower keeps up with payments. Platforms often provide dashboards to track repayments and returns in real time. Like any investment, P2P lending comes with risks. The main risk for lenders is borrower default, where the borrower fails to repay the loan. Platforms may offer risk assessment tools and diversification options, but it's important for lenders to understand that returns are not guaranteed. Borrowers also face risks such as high interest rates if their credit is poor. Borrowers benefit from P2P lending in several ways. The process is often faster and more flexible than traditional bank loans. Borrowers may qualify for lower interest rates and have access to funds even if they don't meet strict bank criteria. The online nature of P2P platforms also means greater convenience and transparency throughout the process. For lenders, P2P lending offers the potential for higher returns compared to traditional savings or investment products. Lenders can choose which loans to fund, allowing for greater control and diversification. Many platforms provide detailed borrower information and risk ratings, helping lenders make informed decisions and manage their portfolios effectively. Regulation of P2P lending varies by country. Many governments have introduced rules to protect both borrowers and lenders, such as licensing requirements and disclosure standards. Platforms are required to follow strict security protocols to safeguard user data and funds. It's important for users to choose reputable platforms that comply with local regulations. Modern P2P lending relies heavily on technology. Platforms use advanced algorithms to match borrowers with lenders, assess risk, and automate payments. Data analytics and machine learning help improve credit assessments and detect fraud. The result is a more efficient, transparent, and user-friendly lending experience for everyone involved. P2P lending is a global phenomenon with platforms operating in countries around the world. While regulations and market conditions vary, the core principles remain the same, connecting borrowers and lenders directly. This global reach allows for greater access to capital and investment opportunities, regardless of geographic location. Consider Jane, who needs a personal loan to consolidate her credit card debt. She applies on a P2P platform and her application is reviewed and approved. Several lenders contribute small amounts to fund her loan. Jane receives the money quickly and repays it in monthly installments while the lenders earn interest on their investment. This example shows how P2P lending can benefit both sides. Now let's look at a small business owner, Tom, who needs funds to expand his shop. He turns to a P2P platform where his business plan is reviewed by potential lenders. After securing the necessary funding, Tom grows his business and repays the loan over time. Lenders benefit from the interest earned and Tom achieves his business goals. P2P lending differs from traditional banking in several ways. Banks act as intermediaries, often charging higher fees and offering lower returns. P2P platforms connect borrowers and lenders directly, reducing costs and increasing efficiency. However, banks may offer more security and established reputations. Understanding these differences helps users choose the best option for their needs. For lenders, diversification is key to managing risk. By spreading investments across multiple loans and borrowers, lenders can reduce the impact of any single default. Many platforms offer automated tools to help with diversification, making it easier for users to build balanced portfolios and protect their investments. Transparency is a cornerstone of P2P lending. Platforms provide detailed information about borrowers, loan terms, and risks. This openness builds trust between users and helps everyone make informed decisions. Many platforms also publish performance statistics and user reviews, further enhancing credibility and confidence in the system. Despite its benefits, P2P lending faces challenges. These include regulatory uncertainty, risk of fraud, and economic downturns that can increase default rates. Platforms must continually adapt to changing conditions and invest in technology to protect users. Staying informed and cautious is essential for both borrowers and lenders. Future of P2P lending looks promising, with continued growth and innovation on the horizon. Advances in technology such as blockchain and artificial intelligence could further improve security, efficiency, and accessibility. As more people seek alternatives to traditional finance, P2P lending is likely to play an increasingly important role in the global economy. If you're considering a P2P loan, start by researching different platforms and comparing their terms. Check your credit score, understand the interest rates, and read all the fine print before applying. Make sure you can afford the repayments and use the loan for a clear, productive purpose. Being prepared will help you get the best deal and avoid potential pitfalls. For lenders, it's important to diversify your investments and use the tools provided by the platform to assess risk. Start small, learn how the system works, and gradually increase your exposure as you gain confidence. Monitor your portfolio regularly and stay updated on platform performance and borrower trends to maximize your returns. Peer-to-peer lending is transforming the way people borrow and invest. By connecting individuals directly, it offers greater flexibility, transparency, and opportunity for both borrowers and lenders. As technology continues to evolve, P2P lending will likely become an even more integral part of the financial landscape. Whether you're looking to borrow or invest, understanding P2P lending empowers you to make smarter financial decisions.